The FAANG stocks in particular have seen a pretty powerful breakout just over the last month. Been watching all of these stocks and most of them rising pretty sharply. That group has outperformed the rest of the market, rising at least 17% since March. Joining us right now with more on the tech sector is Gene Munster. He's the founder and managing partner at Loup Ventures. And Gene, the rise for a lot of these FAANG stocks makes sense, at least in some instances. But I think you really have to kind of break down and play through to see which ones are the most powerful. Amazon makes a lot of sense. People are relying on that more than ever. But this morning, we've seen Apple downgraded at Goldman Sachs. Their concern is that demand is going to be weaker than expected through the middle of this year and then weaker than expected at the beginning of next year when things they think will start to improve. What's your take, first of all, on the overall sector? And then let's talk about Apple specifically.
So the broader sector, I think it's very clear that that there's a divergence here between the winners and the losers within the bigger FAANG stocks. Ultimately, what we're seeing is these large cap companies are going to be leadership roles when we get on the other side of this. There's been this conversation about the large cap tech stocks are going to have some sort of better or greater compliance, greater government regulation. Ultimately, I don't think that that's the case. I think investors are more broadly looking at these stories as very reliable, predictable, and going to be leaders on the other side. I'm curious, Becky, for your perspective, when you hear about government regulation, does the thought ever cross your mind that these companies are going to be actually better positioned on the other side of this?
Potentially. Look, I think it depends on the company, though. We talked to Barry Diller yesterday, and he talked about how at Expedia, you know, forget about the government regulation. I don't think the government has time to focus on regulating these companies at this point. But just in terms of advertising, Barry Diller said yesterday that Expedia, they normally would spend $5 billion. Well, that's going to be less than $1 billion this year. And that's got to be playing out through a lot of different places. And you have to wonder the impact that that's going to have on a place like Facebook or on Alphabet. In fact, Alphabet already saying they're not going to be hiring over the course of the next year, and they're going to be cutting back on some of the projects. What's your take just on those that are more reliant on advertising dollars?
Well, I think they're a bigger risk here. And I think this split in terms of how the FAANG is going to perform is really important. And one of the biggest takeaways over the past month, absolutely agree, is that FAANG has a leadership role. But if you look at what's happened with Amazon and Apple, those two stocks being up 28% in the past month, and then you flip around and look at what's happened with the advertising stocks, Google and Facebook, they've performed well over the last month since the lows of March 23rd, up, call it 20%, but have lagged. And I think what investors should take away really is two things here. First is this concept that big tech is going to play a leadership role, regardless if it's Amazon, Google, Facebook, or Apple. But within that context, I think that there are going to be even bigger winners. And I think about this Goldman Sachs downgrade today, and I think it really is tone deaf. If you look at what Apple is doing, just not only around wellness, but around 5G, but the bigger picture, Tim Cook's comments yesterday at their employee meeting, he talked about making decisions for the long term. And that what that means is that is code that they're going to have some ugly earnings numbers here over the next, when they report the March quarter. If you just look at their earnings or their spending on their retail alone, that could have a negative 5 to 10% impact on the March quarter because they continue to pay for those employees. But what he also said was that they are continuing to invest in products. And you've seen the cadence with the most recent iPhone SE. And I think what investors should take away here is that companies like Apple, they're laying the groundwork to grow for the next, call it 5, 10, 15 years. And I just want to kind of quickly accelerate to the end and put this into context. The companies that are making the right decisions now to continue to invest in the business, those companies with the strongest balance sheets are the ones that are going to outperform the most. And I think you could build a strong case that Apple is call it a $575 stock. If you grow simply earnings at 15% for the next 4 years, put a 25 multiple on that. There's a lot there, Becky, but I want to really emphasize is that these big tech companies, especially Apple and Amazon, are going to play leadership roles for many years to come. And this is ultimately an opportunity.
Gene, are there any of the stocks that you wouldn't buy right now, or you'd say basically load up on all of them, but load up on Apple and Amazon more?
Well, I would actually take Apple much more over Amazon. I mean, they're both great infrastructure plays, but just the earnings basis, the earnings power around Apple, I think is is significantly greater longer term than Amazon. The one that I would be the two that I would be actually a little more nervous about of those big tech names is companies like Facebook longer term. They're just simply, Mark Zuckerberg is well intended, but they're not changing the world at the same velocity that Apple or Amazon is. And then the second one is, even though Netflix has had a great run here, I still don't feel that that is justified on a valuation basis. I do predict that in the years to come, we're going to see actually a reshuffling of FAANG. And I think that the two stocks that are going to replace, if we want to take out Facebook and Netflix, I think the two stocks that will replace that are going to be Tesla and Microsoft. I don't know what the proper acronym around that is, but those are the companies that are really building into these undeniable truths, things that will sustain beyond any sort of challenges that we have in the near term. And so look for to kind of shift away from companies like Facebook and Netflix and really embrace some of those other companies.
AMATA. That would be if you're right, that would be the new acronym.
Yeah,
AMATA.
there is like an insect that has, or a body part of an insect. That may be AMATA, but not as catchy as FAANG by any measure. But I do think that those two, welcoming Tesla and Microsoft into that elite group, is an inevitable. The one thing I want to leave people with is that the comfort that we've had in investing in the past, in FAANG in the past, those days are gone. Like this concept that just advertising businesses are great. We have to invest in companies that are really empowering the new economy and things around wellness, around 5G, those types, electrification, autonomy. That is the mantra for proper investing of the future.